Okay, so let me share with you one simple technique. Let's say we are over here in the chart of TCS. Okay, and let's say we come to this part. On this day, this was TCS on the 3rd of May 2017. I am on a Heiken Ashi candlestick. I see a fall and I see that TCS, the daily chart, has both an upper shadow as well as a lower shadow. When the scenario is like this, there is no defined uptrend or downtrend, so I'll be waiting. I also observe that the highs are close to that 2300 mark, 2320. Every time it comes close to 2320, it's kind of a resistance. So I will wait for a definite sign of a strong uptrend or strong downtrend. I notice that the candles, the Heiken Ashi candles, have started to turn color and there is slight positive bias coming in. No action to be taken right now. The next day, I noticed that the market, the stock, moved up, and this is the first time that I noticed that there is no lower shadow. As there is no lower shadow, it confirms that I am now in a strong uptrend and my bias should be completely on the upside. With this in mind, I will be placing an order, the next candlestick, to buy above the highest point of that candle, that is 2324. And I will be placing a stop loss in the previous candle's low. I will be placing a buy above the high of this candlestick, and my stop loss will be to my left of my candle. Wherever there is a lower shadow, there has to be a lower shadow, low of this. Next day I notice supports and resistance works in Heiken. Yes, to a lot of extent they will. Next day, to my surprise, I noticed that it did not follow through. On the other hand, I got a red Heiken with both the upper shadow as well as the lower shadow. So essentially the trend has gone again flat. I may or may not keep my trade. I may or may not place my order over here. Keeping in mind it was a downtrend, keeping in mind that it's gone into a consolidation, keeping in mind that I've got this candle over here, I'll suggest that you should keep your order and wait for what happens the next day. The next day, it again makes a positive, strong Heiken Ashi candle, an uptrend. And now what will I do? I'll place a new order, a fresh order to buy above this high, which is a tad below the previous high. So I buy above this high and I will look for the nearest lower shadow, and the nearest lower shadow is over here. So my buy happens over here close to that 2320 mark, and I place a stop loss over here close to that 2270 mark. I wait for my order to get triggered the next day. Let's see what happens. My order gets triggered. TCS continues its move on the upside. I go into a long trade and the day ends and I notice that there are no lower shadows. There are no lower shadows. So my stop loss stays over here. So I think I can draw a line, an horizontal line. So my stop loss stays over here. What happens the next day? Next day, TCS consolidates and now I got both an upper shadow as well as a lower shadow. I am already in a long trade. So all that I have to do is continue my long trade. I will trail my stop loss to this low. I will trail it to this low. Again, I get a lower shadow. I will ideally trail my stop loss to this low. I see that prices have come down below my stop loss. So if I had trailed it, I am out. If you have not trailed it, you're still okay. If you're out, I will suggest that you keep your buy triggers above this price again because you will notice that the stock is essentially consolidating. It picks up. If you have exited, you would enter again. If you have not entered, I'll suggest you put a buy over here. Big move, no lower shadow. Now it's time for you to trail your stop loss. Your new stop loss can be at this low, or from this low you would have trailed it up to this low. Move continues, no lower shadow, no lower shadow, no lower shadow, nothing yet, not yet, not yet. Now comes a very minute lower shadow. You might wait for one. Here comes a red candle. You take your stop loss straight away up here, and if it gets triggered, you exit. If it gets triggered, you exit from that. When you exit from this trade, you notice that the trend has turned down, means there is a red candle with no upper shadow. In that instance, in that case, you may look to sell below this, and you will be placing a stop loss at this higher shadow. When you get a red candle with no upper shadow, that's a signal of a strong downtrend. Once you have a confirmed downtrend, on the next bar, you would be looking to initiate a short, and if you sell it, then you will use the previous recent upper shadow, which is this one, as your stop loss. Okay, we'll see what happens. So if we place an order to sell below this, nothing happens. Again, we have these two shadows on the up and down. This low is more or less close to this low, so no worries. I'll still keep my order. It's consolidating. I'm still waiting to sell. Now it reverses up and there is no upper shadow. So I will cancel my short trade. And essentially look to buy here. And if this buy gets triggered, my stop loss will be the previous low over here. My buy gets triggered, no lower shadow, new lower shadow. I'll take it up from this point. I trail it up over here. I'm out. So this trade, I entered over here 60-63. I exited over here 49, around 10-13 points. This trade went on pretty well because it was a nice trend on the upside. I get brutally stopped out, though I had seen some movement. So partial profit takings, we will explain this later on. Now we get a strong negative candle. So ideally I should be looking to sell below this. And I should be looking to place an order the nearest upper shadow, which is here. Now this is really wide. This is really wide because the candlesticks, the ranges have gone really wide. That's why. If you have taken the short trade, falls further down, no higher shadow, no higher shadow, not yet, no higher shadow. Now comes in higher shadow. The moment the new higher shadow comes, you take your stop loss down to the new higher shadow. You'll notice that it's been a nice fall. Ideally, one should look to book some profits out because the candles have gone smaller. The moment Heiken Ashi candlestick goes small, like the spinning tops and the dojis, that's an early sign. It just marginally probably will take you out or probably go into a doji kind of a formation. Again, 2-3 candles like this. So essentially it's forming a base, it's forming a range consolidation. Now, when you see candles like this after a fall, it's a big question mark whether I'm going to continue on the downside or whether I'm going to break out on the upside. Now, remember one thing, you can wait for a strong down candle or a strong up candle, number one. Or if the prices have created a range with the shadows, you see, I can clearly see a range on the upside, 24.50. I can clearly see a range on the downside, 23.80, 85. So you can place your orders in the range breakout. Breaks out on the downside, strong negative candle, So you've got confidence now that the trend is on the downside. If you have sold below this zone, that is, if you have got stopped out here, you will sell again below this zone. If you do that, you will keep your stop loss to the nearest upper shadow, that is this one. Nice move on the downside, no upper shadows, no upper shadows, new upper shadow. You take your stop loss down over here, and this is where we stand. According to Heiken Ashi daily chart of TCS, you're essentially short with a trail stop loss. And obviously we got TCS because we have a bullish engulfing in our conventional candlesticks. Now this kind of trading is not a very smart one. I'm just showing you how it can be done. We will improvise upon this, we will improve upon this, but to improve upon anything we need to first have a base. So the base is like this. We have to wait for a positive uptrend, strong uptrend signal from Heiken Ashi. That comes from a candle which does not have an lower shadow. We buy above the high, we keep a stop loss to the nearest lower shadow. The opposite is when we have a strong downtrend which is signaled by a red Heiken Ashi, which does not have a higher upper shadow. When we have an Heiken Ashi candle like this, we will sell below the low with the nearest upper shadow as the stop loss. This concept, this technique will work for you in any time frames. For example, if I change the TCS daily chart to the 5-minute chart, you will notice that even in 5 minutes, there will be such candles. If I increase from the 5-minute to, let's say, the hourly chart, you will notice, I'll just remove these day changes. Yeah. You will notice that this applies in the hourly charts as well. Look at this fall and look at this rise. Exceptional nice move on the upside as well as the downside. Now the point is, it is very simple, it's very easy, but it's got one big drawback. A very distinct downside, a very distinct disadvantage of this technique. You see the TCS hourly chart in front of you, and if you visually try and figure out, okay, this is where I would have traded and I would have exited, what stands out? What is a big drawback of the Heiken Ashi candlestick technique, the technique that I shared right now, is it's going to work exceptionally well when there is one way move up or one way move down. However, if it goes into a range, if prices goes into a range, then there can be small drawdowns. Means if the prices have gone into a range, let's say like this, you notice over here, then you might get in and out of trade multiple times. So there will be multiple trades where you will be making small losses. Now Samir said that there's a possibility of a big loss. Now if you follow this concept, there will not be a big loss, but there will be multiple small losses. And when the stock or the chart picks up a trend up or down, you will have big gains. So lesser number of big gains and larger number of smaller losses. This is what an Heiken Ashi trading will lead to, and this is essentially trend following in nature, is that I need to understand the trend, I need to evaluate the trend, I need to have a trend in my hand, up or down, and the moment I have it, I need to just follow my trend. So the Heiken Ashi rule that we had just discussed is a typical trend following rule. We said that it has to be a positive candlestick with no lower shadow. And if you have something like this is an implication that this is an uptrend. So my definition is done. And once you have defined a trend, all that you will be doing is try and follow it until and unless it reverses. So you will exit. So this concept, this nature, this type, this philosophy of trading is essentially trend following in nature. Any trend following strategy under the sun has its biggest strength and its biggest weakness. As the biggest weakness would be that it will have large number of small loss making trades, large number of small losers, and it will have a small number of huge gainers. This is the biggest takeaway from any trend following system. It's like anyone who is doing trend following would like to ask you the question, do you want to go right in the market or do you want to make money in the market? Right? So they believe that they are more interested in making money in the market rather than going right. How can you go wrong and make money in the market? So they essentially will take 10 trades. Out of that, 7 might go wrong and 3 might go right. In the 7s which go wrong, they might lose 1 rupee, 1 rupee, 1 rupee. So they are down 7. The 3s where they make money, they probably make 3, 4, 5 rupees each. So let's say even if they make 4 rupees each, they make 12. So when I net it out, I make end of the day 5 bucks. So essentially what trend following holds from this little simple maths is their few winners are significantly greater than their multiple losers. One winning trade will wipe up 3 to 4 losers. This is trend following. As I said, we'll get into trend following in details later again. I'll be sharing the turtle trading strategy with you. The turtle trading strategy with you, which is a trend following in nature, and how trend following is not for everyone. You need to have a certain kind of a mindset. You need to have a certain kind of belief in the market. You also need to be a certain type of trader or investor to actually do trend following. It may not suit you.